Hello investors, and welcome to our channel. Today, we're going to dive deep into one of the most well-known and game-changing companies of the 21st century, Netflix. It changed how we watch entertainment, put video rental stores out of business, and taught us what binge-watching a series means. But the billion-dollar question is, after explosive growth and becoming the absolute queen of streaming, is Netflix, with the ticker NFLX, still a good investment? The landscape has changed. Competition is fierce. The market seems full in some areas, and many wonder if its best growth days are behind it. In this video, we're going to do a full analysis. We'll look at the company's brilliant strategy, its economic moat, its financial health that went from worrying to excellent, the risks it faces in the so-called streaming wars. And of course, we'll talk about its value. So if you own shares, are thinking about investing, or just want to understand the future of one of the tech giants, stick with me until the end. Let's get started. The brilliant strategy and business evolution. To understand Netflix's future, we need to look at the brilliant decisions that brought it here. Netflix's strategy was, in one word, visionary, and it's built on three main pillars. Pillar 1, organic growth and no old baggage. While giants like Disney and Warner had to manage the decline of their cable TV channels and movie box offices, Netflix was born 100% digital. It didn't have an old business to protect. This allowed it to focus all its resources and energy on one thing: building the best streaming service in the world. Pillar 2, avoiding the live sports trap. Reed Hastings, the founder, was very smart here. He saw the temptation to get into the fight for broadcasting rights for major sports leagues, like the NFL or the Premier League. This would bring subscribers, no doubt. But at what cost? Contracts are super expensive, short-term, and create a customer base that only stays as long as you have that sport. Netflix wisely decided that its money would be better invested in its own content, which it controls forever. Pillar 3, the shift to original content. In the beginning, Netflix was a big aggregator of content from other studios, but it realized that this was a vulnerable position. As soon as studios launched their own streaming services, they would pull their content. That's when Netflix bet tens of billions of dollars to build its own studio, producing global hits like Stranger Things, The Crown, Squid Game. Today, Netflix is a Hollywood powerhouse, and this strategy continues to evolve. Recently, we've seen two crucial moves: the end of password sharing and the introduction of the ad-supported plan. The crackdown on password sharing, which many thought would backfire, proved to be a huge success, bringing millions of new paying subscribers. The ad-supported plan opens up a new and massive revenue stream and attracts an audience that wasn't willing to pay the price of traditional plans. This shows that the company isn't stuck in the past. The economic moat, the competitive advantage. Okay, the strategy is good, but what stops Disney, Amazon, or any other multi-billion-dollar company from simply copying and crushing Netflix? The answer lies in what we, as investors, call an economic moat, the competitive advantages that protect a company. Netflix has a moat that we classify as narrow but very powerful, based on two factors: intangible assets and network effects. Intangible asset, the subscriber base. Netflix's most valuable asset is its massive global subscriber base. We're talking about over 280 million paying households worldwide. No competitor even comes close to that. This subscriber base isn't just a number, it's the engine of a virtuous cycle. And that's where the network effect comes in. It works like this. More subscribers generate a mountain of money in predictable and recurring revenue. This money allows Netflix to invest more in content than any other streaming service. We're talking about almost $18 billion a year. More quality content and quantity attracts and retains even more subscribers. It's a self-reinforcing cycle. The bigger Netflix gets, the stronger it becomes, and the harder it is for competitors to keep up with the pace of investment. And there's more. Netflix has created a cultural phenomenon that I call the Netflix effect. Shows that had modest success on other networks suddenly become massive global hits simply by being on Netflix. The most famous and recent example was the series Suits, which became a sensation a decade after its premiere, or Formula One: Drive to Survive, which basically popularized the sport in the United States. This means that talent wants to be on Netflix because the platform has the power to turn projects into successes. And customers hesitate to cancel because Netflix is seen as the main destination for discovering what to watch. Financial X-ray, the money-making machine. For many years, the main criticism of Netflix was, great company, but it burns too much cash. Investing billions in content meant operating in the red or with negative cash flow. Well, investors, those days are over. Let's look at the numbers. Netflix ended the first half of 2025 with a very healthy financial position. The net debt to EBITDA ratio is less than 1. And most importantly, the company expects to generate over $9 billion in free cash flow in 2025. And that number should grow year after year. This means that even after spending $18 billion on content, there's still a lot of money left over. Where does that money go? Netflix doesn't pay dividends, and it's not likely to anytime soon. The priority is to reinvest in the business. The excess cash is being used for a share repurchase program, which is great for shareholders, as it reduces the number of shares outstanding and increases earnings per share. And revenue growth? An average annual growth of 10% is expected over the next 5 years. Where will it come from? International markets. Asia Pacific is the fastest growing region, followed by Europe and Latin America, where penetration is still much lower than in the United States. Price increases. The company has pricing power and should continue to gradually increase prices every 1 or 2 years. Advertising revenue. The ad-supported plan is still in its early stages and has huge growth potential. The result of all this is an expected and substantial expansion of margins. The operating margin, which was 27% in 2024, could exceed 36% by 2030. This is operational leverage in its purest form. Risks and uncertainties. The digital content war. Now let's put on our skeptical hats. The situation isn't all sunshine and rainbows. Netflix faces real risks that every investor needs to know about. Risk 1. Brutal competition. The golden age, where Netflix was the only option, is over. Today they're fighting with deep-pocketed giants. Disney Plus, with Hulu. They have an unmatched catalog of intellectual property. Marvel, Star Wars, Pixar. Amazon Prime Video. It comes bundled with the Prime package, which makes it hard to cancel. Max, Warner Bros. Discovery. Owner of HBO, a name synonymous with super high-quality content. This competition means the content war will keep going, keeping production costs high. Risk 2, the content treadmill. Netflix constantly needs to make new hits to keep subscribers hooked. What happens if the company goes through a creative dry spell, with many new shows that people don't like? The risk of cancellations, the famous churn, goes up. Keeping the hit-making machine running at full speed is an expensive and never-ending challenge. Risk 3, market saturation and pricing power. In the United States and Canada, the market is mature. Growth in new subscribers will likely be very low, close to population growth. The question is, how long can Netflix keep raising its prices in this area before customers say, enough is enough? Testing the limits of pricing power is a risk. Risk 4, international challenges. Growing globally isn't easy. It means making local content that's right for each culture, like we saw with Money Heist in Spain or Squid Game in Korea. Getting it right in dozens of different countries is complicated and expensive. Valuation. Is the NFLX stock expensive or cheap? The bull case, optimistic. Optimists will tell you that Netflix is the undisputed leader with a strong economic moat. The shift to becoming a cash-generating machine, the potential of advertising, and the long runway for international growth justify the valuation. The company is just starting to show its true earning power. The bear case, pessimistic. Pessimists will argue that the multiple is too stretched, considering the strong competition and the slowdown in subscriber growth in mature markets. Any misstep in execution or a weak quarter could cause a big correction in the stock price. The main point here is that Netflix is no longer valued just by subscriber growth, as it was in the past. The market is now focused on earnings per share and especially on free cash flow generation. And, by these metrics, the company is delivering impressive results. So after all this analysis, what's our verdict on Netflix? Netflix has made a fantastic change. It went from being a company that spent a lot of money just to grow to a smart, well-managed, and very profitable leader in the market. Its strong advantage, built on its size and how its network works, is still solid, making it really tough for competitors. The company has many ways to grow, especially with ads and expanding to more countries. But investors need to know about the risks. Competition isn't going away, and they'll always need to spend billions on new shows and movies. Also, for the stock price to make sense, the company has to keep doing everything perfectly. Our conclusion is, for long-term investors who believe that the streaming market will end up with just a few big winners, Netflix is definitely the strongest horse in this race. The stock might not be super cheap, but you're paying for quality, leadership, and a profit power that's just now really starting to show. Remember, this video isn't advice to buy or sell. Always do your own homework. What about you? What do you think of Netflix? Are you a shareholder or are you thinking about buying? Share your thoughts in the comments below. We'd love to chat with you all. If you like this analysis, don't forget to hit the like button, subscribe to the channel, and turn on notifications so you don't miss our next videos. Thanks for watching and see you next time.